Hi everyone, thanks for joining us during your precious lunchtime today. I am Joyce Liu, Senior Client Advisor at Endowus, and I have with me today Shun, who is an investment associate at Endowus, who is in charge of the portfolio we are introducing today, and that is the Endowus Real Assets Portfolio. First and foremost, the disclaimer. This presentation is for information purposes only and should not be considered solicitation or investment advice. Please reach out to your assigned client advisor or write in to support@endowus.com if you require any investment advice. Throughout this webinar, you may also ask questions on Slido. Simply go to slido.com and key in real assets. A quick reminder of what Endowus stands for. Most in the audience are existing clients and would be familiar with Endowus already. Our mission is to empower everyone to invest better so as to live better. And we do so through conflict-free advice, institutional access to funds, and low fair fees. Our shareholders include major global banks such as UBS, Citi, and MUFG, as well as EDB's venture EDBI and billionaire family offices. But more importantly, our biggest shareholder is Endowus employees. So our clients' interests are our interests. Moving on to today's topic on real assets, some among us would have spotted a similar sounding portfolio that we have in our existing suite of satellite portfolios, the real estate portfolio. The real assets portfolio that we are introducing today is essentially an upgrade of our real estate portfolio. Shun will elaborate more on this later. But first, what are real assets? Real assets are tangible and physical assets that come early in the supply chain and derive their value from contractual rights or ownership claims. There are four main types of real assets: real estate, which more commonly we know it in the form of REITs. So they come in the form of residential, industrial, retail, also hospitality and healthcare. But more than just real estate, there is also other types of real assets, such as infrastructure, natural resources, and commodities. Infrastructure, think about toll roads, think about power stations, think about water and waste, and other public assets. For natural resources, examples are energy, agriculture, timber, metals, and mining. And commodities, familiar names would be gold, silver, corn, oil. Gold in particular, many of us are very keen on. Now, for real assets, there are three common characteristics that I would like to highlight that make them valuable as investment assets. First, real assets have typically low correlation with traditional asset classes. Traditional asset classes are simply publicly traded stocks and bonds, which all of you will be very familiar with. As a type of distribution-paying asset class, real assets provide a source of income that is relatively uncorrelated to the bond market. Second, real assets is one of the only inflation-adjusted asset classes. For example, service contracts and rent increases can help mitigate against the effects of expected and unexpected inflation. Lastly, the predictability of its distribution is well loved by investors. The long-term lease structures of core real assets can provide strong, predictable cash flow and stability to the return stream. Let's take a closer look at these four types of real assets, rating them by their investment rationale of their inflation sensitivity, diversification potential, and expected return. Now, you will observe from the pie charts that while real estate and infrastructure are more similar in nature, they are ultimately different from the rest. Adding commodities to the portfolio is a good inflation hedge and diversifier. Natural resources equity, on the other hand, is typically ahead of economic cycle and is also a very, very good inflation hedge. All these are important elements to add to a portfolio if long periods of sustained inflation is to be expected. And even more importantly, real assets, especially non-real estate real assets, is an important hedge for unexpected inflation. The highlighted columns show the difference in performance between the existing real estate portfolio versus the new real assets portfolio during periods of inflation, whether it's rising inflation or unexpected inflation. Putting it into a longer term perspective, taking 50 years of data instead of the most recent 6, the role of real assets as an inflation hedge is even more pronounced. Real assets have historically benefited from both rising and unexpected inflation. I hope you are convinced by now on the potential role of real assets, not just real estate on your portfolio. With that, I will hand over to Shun to delve into the details of the real asset portfolio.
Thank you, Joyce. We are excited to share with you the Endowus Real Assets Portfolio. So the portfolio will have three main objectives, which we will elaborate in more detail later. So firstly, as discussed by Joyce, a higher inflation sensitivity as compared to other asset classes. This is done through an addition of commodities and natural resources companies. Secondly, historically, real assets have had equity-like returns over a full market cycle. Real estate and infrastructure tend to have higher returns in the longer term, thus they would form the core of the portfolio. And lastly, we believe that the portfolio is complementary to your flagship or core portfolios. This is as real assets typically exhibit lower correlation to traditional asset classes like equities and bonds. So on the next slide, we will actually be highlighting the longer returns of real assets. Our first table actually illustrates the performance from 1972 to July 2024, revealing that global real estate has actually outperformed global equities during this period, while commodities actually experienced numerous market cycles characterized by bull and bear runs, thus the lower returns. The second table below that illustrates returns since 2001 shows that the performance of real assets has generally been in line with global equities, actually also showing a slight outperformance despite experiencing a slightly marginal higher volatility. The stronger, longer-term performance of real assets can be attributed to their ability to provide investors with a consistent income stream regardless of economic cycle. This is as the underlying businesses has long contracts with potential inflation-linked growth. For instance, in real estate, generally they will receive regular cash flows through tenant leases and can actually increase rents when there's inflation, or if you look at infrastructure companies, they typically have long contracts or regulations that protect them. This reliable income stream is a key factor in the appeal of real assets for long-term investors. On the next slide, we actually present a chart from Goldman Sachs illustrating the performance of real assets across various market conditions compared to the benchmark. So in the first two charts, during Goldilocks periods, which is characterized by steady economic growth and moderate inflation, growth stocks actually outperformed the broader S&P 500 index by 2%, while all components of the real assets have actually underperformed during this period. The third chart depicts stagnation, where low economic growth actually coincides with moderate inflation. This period is particularly favorable for real assets equities, which have historically outperformed the S&P 500 by 10% over a 10-year period. Additionally, gold has outperformed the 60-40 benchmark by 15% during this period. And the fourth chart actually focuses on stagflation, marked by low economic growth and high inflation. Here, real assets actually demonstrate notable outperformance against the benchmark. Real assets equities outperformed the S&P 500 by just under 5%, while commodities represented by the S&P Goldman Sachs Commodity Index, which is the GSCI, outperformed the 60-40 benchmark by 10%. Overall, these findings indicate that during periods of lower growth coupled with higher inflation, real assets have the potential to outperform traditional benchmarks. On to the next slide, we wanted to showcase the lower correlation of the underlying assets to global equities. Correlation essentially is how two asset classes will move in relation to one another. And using commodities here as an example, a correlation of 0.47 will indicate that they have a low positive correlation, which means that the prices do not tend to closely track the ups and downs of global equities. So adding real assets to a portfolio can help diversify your equity exposure, and also obtain access to an often underrepresented sector. So to put this into perspective, the MSCI Equity Index, real estate sector is only 2.2% of the index. So on this slide, actually, if you look at the last row in the table, which showcases the common underlying holdings between the funds and the benchmark, there's actually a low common holding, which is expected. This could actually provide diversification as well as differentiation, and that could actually be complementary to your flagship or core holdings. So here we'll illustrate how all the components would synergize within the portfolio. As Joyce highlighted in a previous slide, each category possesses distinct characteristics regarding inflation sensitivity, diversification potential, and expected returns. So by integrating all of this, we can actually expect the overall portfolio to exhibit moderate inflation sensitivity and diversification potential, while also yielding slightly higher expected returns. We'll elaborate more on the changes to the portfolio in the next slide. So the model portfolio will actually consist of real estate infrastructure. On the next slide, the model portfolio will actually primarily consist of real estate and infrastructure allocated at 45% and 40% respectively. Natural resources equities will make up 10%, while commodities will account for 5%. So to enhance the portfolio dynamism, we would also be removing 3 funds and adding 5 new funds. So within the global real estate segment, we plan to increase the number of funds from 1 to 2, to ensure manager diversification. So we'll introduce the Nordea Global Real Estate Fund and reduce the allocation of the Janus Henderson Property Fund from 50% to 25%. We will also remove the 2 Asian real estate funds due to their geographic focus and relatively small asset under management. Additionally, we will also replace the BlackRock Global Real Asset Security Fund, which has a 50% allocation to real estate and 50% allocation to infrastructure, and replacing this with 2 dedicated infrastructure funds, which is the M&G Global Listed Infrastructure Fund at 25% allocation and the KBI Global Sustainable Infrastructure Fund at 15% allocation. As previously mentioned, there will be a 10% allocation to natural resources equities, and this is done through the addition of the 91 Global Natural Resources Fund, and a 5% allocation to commodities via the PIMCO Commodity Real Return Fund. The net total expense ratio will be slightly higher by 4 basis points to 1.18%. So please note that this portfolio will initially be for cash only, as we are still coordinating with some fund managers to register their funds for SRS. I will actually provide more detail on the funds, on each individual funds on the next slides. So firstly, we would like to introduce the Nordea Global Real Estate Fund, which is actually a very high quality fund that was recently onboarded onto a platform and is actually focused on owners and operators of real estate. The fund is sub-managed by Duff & Phelps, a boutique firm that is based in the US that oversees over 12 billion in assets. The investment strategy actually employs a bottom-up and top-down approach, allowing them to access macroeconomic environments to establish initial sector preferences before conducting in-depth fundamental analysis of individual stocks. So this actually includes the evaluation of management effectiveness and capital allocation strategies. The result of this disciplined approach have actually been impressive, as demonstrated on the graph on the right, which shows that the fund has outperformed the benchmark since inception. We believe that the fund will be complementary to our current existing global real estate holding, which is the Janus Henderson Fund, This is as the Janus Henderson Fund takes on a more thematic approach and benefits from a larger team that is capable of investing in smaller market cap real estate stocks. So next, we will actually like to introduce the first of the two infrastructure funds in our portfolio, which is the M&G Global Listed Infrastructure Fund, which would serve as the cornerstone of our infrastructure allocation. The fund actually focuses on three main themes as illustrated on the diagram on the left. The largest allocation is to economic infrastructure, which is the light green portion, followed by evolving infrastructure, which is the red, and social infrastructure, which is the blue. So economic infrastructure actually encompasses traditional sectors such as energy, utilities, and transportation. Think more of like utility plants, pipelines, toll roads, and airports. Evolving infrastructure includes investments into towers and data centers. And lastly, social infrastructure focuses on essential services such as hospitals and schools. The fund actually employs a bottom-up investment approach with a strong emphasis on dividend growth, which they view as a very reliable indicator of real cash flow growth. So since inception, the fund has actually demonstrated impressive performances, ranking it among one of the top retail registered funds, infrastructure funds in Singapore. So we're confident that this fund will actually provide a solid foundation for our infrastructure bucket. So next up, we have the KBI Global Sustainable Infrastructure Fund, a fund that you may already recognize from our ESG portfolio. So this fund is actually dedicated to identifying infrastructure of the future, focusing on companies that provide sustainable solutions to pressing resource challenges in water, food, and energy. So what actually sets this fund apart from it is that it has this unique approach to infrastructure investing. The team actually seeks opportunities driven by supply and demand imbalances for essential resources, thus targeting forward-looking, under-owned infrastructure assets that are poised to benefit from future capital expenditure. As a result, the portfolio is actually notably distinct from the N&G fund, with only a 24% overlap in holdings. This is as the KBI fund actually invests in a very different type of infrastructure, which often includes the smaller market cap companies. We believe this fund will actually add significant value to our infrastructure allocation by aligning in our commitment to forward-looking companies. So next, we actually would like to introduce the 91 Natural Resources Fund, which primarily invests in companies engaged in mining, extraction, production, and transportation of natural resources. These companies typically benefit from rising commodity prices. So examples of companies include the conventional oil and gas names like ExxonMobil and Shell, miners like Barrick Gold and Anglo American, and agricultural, chemical, and seed companies like Corteva. So the fund actually combines both the top-down and bottom-up approaches and will actually apply a macro input to identify the conviction level for each commodity and subsectors. The team will then actually apply fundamental analysis to identify suitable investment opportunities. So therefore, we feel that this fund will provide the portfolio with a broad exposure to natural resources companies that can provide a degree of inflation protection. And the final addition to the portfolio will be the PIMCO GIS Commodity Real Return Fund. So the fund actually aims not only to track, but also to outperform the Bloomberg Commodity Index. Do note that this index has around 18% allocation to gold and 12% allocation to oil. So to achieve its performance goals, the fund actually employs a double alpha approach. So as illustrated in the diagram, exposure to the commodity index is obtained through commodity futures or in other cases, a total return swaps. So a range of active commodity strategies are actually utilized and incorporates both PIMCO's macroeconomic and fundamental views. So in doing so, the team actually seeks to avoid inefficiencies of the passive commodity indexing and take advantages of price dislocation within the commodity markets. During these swaps and futures transactions, collateral is required. So PIMCO will strategically use this collateral to invest in high quality treasury inflation protected securities. or commonly known as TIPS, to further enhance the overall return of the portfolio. So the result of this is outperformance over the benchmark of over 1% since inception. So putting it all together, on the next slide, you can actually see the performance of the portfolio versus the global real estate portfolio since inception of the underlying fund in January 2018. The new portfolio has cumulative returns of 40% and an annualized return of 5.1%. That is around 2 times that of the current global real estate portfolio. So for context, the SG REITs ETF has returned roughly around 2.1% during that time, while global equities index have returned 9%. To dive deeper, the stronger performance is on the back of an allocation to more sub-asset classes like natural resources equities and commodities that have actually helped the portfolio to hold up better. So for instance, in 2022, when Russia's invasion of Ukraine triggered a surge in inflation, the portfolio was better protected due to its allocation to natural resources and commodities. These assets actually benefited from the significantly rising commodity prices, which provided a buffer against the broader market volatility. With this enhanced funds options and a diversified asset allocation approach, we're confident that this portfolio has the potential for attractive risk-adjusted returns. So on the next slide, the growth of wealth chart can actually help you visualize this clearly, as you can see the divergence between both the portfolios post 2022. So next up, we would actually like to present the geographical allocation of the new portfolio. So notably, there's actually an increase in the allocation to the US and a decrease in Asia, following the removal of the 2 standalone Asian real estate funds from our holdings. The overall allocation to Asia, including Japan, has decreased significantly from over 30% to less than 13%. So on the next slide, we will explore the changes in our sector allocation. The previous portfolio featured an 80% allocation to real estate and 20% into infrastructure. In contrast, the new real assets portfolio presents a more diversified approach with approximately 53% allocated to real estate. We have also increased our sector exposure, increasing allocations to energy and materials. So this shift actually allows for greater diversification across various sectors. So next up, we'll actually have Joyce, who will discuss how you can actually access this updated portfolio.
Thank you, Shun. A lot of information has been shared, and so if you feel you feel free to ask any questions in the Slido, and also the link to this YouTube will be available, so you can always go back to playback on what Shun has shared, whether on the real assets portfolio or on the new funds that has been introduced. So the question now is, how do we opt in for the recommended changes? 2 different ways. One is for existing clients, of course. One way is when you log into the platform, what we're showing now is the desktop version, right? You can click on the notification icon, and you can look for the notification for recommended portfolio change, and then click on review recommendation. Now, if you log in much later, this notification might be all the way down, so you have to scroll down, right? This would be the only notification that has a button for you to click, which is to review recommendation. Another way, if some time has passed and you can't look for that, you can't find that notification anymore, is to really just click into the portfolio, and on the top right-hand corner, select Manage Goal, and you will see View recommended changes as an option. After I've clicked in, what you will see is a quick summary of the changes that we're introducing. If you have forgotten everything that's mentioned in today's webinar, don't worry. Just click on the blue button, continue to view recommendation, and we will show you the changes and the rationale behind it. Just click through the process, and your recommended portfolio change is accepted only after you have confirmed with your SMS OTP. Do take note that there is no deadline to accepting this RPC, and we are not forcing our clients to accept the recommended changes. You may continue to stay in your real estate portfolio if you wish to do so. For existing investors in the global real estate portfolio, do take note that we will only redeem the funds that are no longer part of this portfolio. And we'll also take the opportunity to rebalance your portfolio back to the target asset allocation. This entire process of selling and buying will take approximately 5 to 10 business days to complete, because we have to wait for the funds to come back from the redemption before we can subscribe into the new funds. How about for new investors? For new investors, do take note that the old global real estate portfolio will no longer be available for subscription, as we are retiring it. When you create a new portfolio for the real assets portfolio, simply look for it under the satellites category and make an investment. You will only invest into the new asset allocation. Meanwhile, our investment office will continue to monitor your real assets portfolio and will recommend changes that will improve your portfolio matrix going forward. That's all we have for today. We will proceed on to live Q&A. So on the Slido, we have actually answered many questions already. We have moderators behind the scene answering the questions. So we're left with only a few questions, which we will address here in the call. I think the first one I can take, the two very similar questions. First question is, I have two core flagship portfolios. How will this complement the current core flagship portfolios? Are these similar to REITs and will have dividend income? The second question that is similar in nature is, what sort of portfolio allocation to these real assets makes sense? And for different investment mindsets, one-on-one consultation is best, of course, but generally. So I think as the two audience have rightfully pointed out, this is actually a satellite portfolio, and it is meant to complement your core flagship portfolios, which are for long-term capital appreciation. They are globally diversified. Whereas here, even though we're talking about a very diversified portfolio of real assets, they are still concentration risks in real assets as an asset class, right? And we are not counting tens of thousands of underlyings in this portfolio. We are just counting a few hundred underlyings in this portfolio, and therefore there is still concentration risk. So it falls under the satellite categories. As a rule of thumb, without understanding your specific situation, just very generally, core portfolios should form 50 to 80% of your entire investable net worth, right? Whereas the rest, the balance of 20 to 50% can be made up of satellite portfolios, which this real assets portfolio is an example of. However, there are also other types of satellite portfolios. So you want to diversify your satellite portfolios as well. So you shouldn't be looking at like 50% of this real assets portfolio as your satellite. So satellite can be a combination of this, as well as maybe if you want to take a bit more overweight, for example, right, you want to overweight China or US, or maybe you are even looking at private markets like private equity, private credit, hedge funds. So all these are different examples of satellite portfolios. In general, 50 to 80% in core and the balance in satellite. And this is an example of satellite.
Okay, I see a question that asks about the percentage of the portfolio that is exposed to China and Hong Kong, and how do I see details in the fund documents? Okay, so as I mentioned previously, we'll be reducing or taking away the two Asian real estate funds. So previously, the portfolio, which is the global real estate portfolio, had around 10% allocation in developed Asia. So that actually includes Hong Kong, and 1% in developing Asia. So that includes China. So after the shifts, currently now, the new portfolio, which is the real assets portfolio, has around 2.4% in developed Asia and 1.3% in developing Asia. So you can see that the allocation or exposure to China and Hong Kong has been reduced quite significantly. And I also see another question about whether investing into real assets portfolio it's a good time. It's a good time now considering the current high interest rates environment that is projected to come down. I think that's a very good question. So the thing is that we are currently in the aftermath of a very historic central bank hiking cycle, and this has actually set the stage for a potentially good regime, especially for listed real assets. I think this is as we've seen a lot of data that basically within real estate, within infrastructure, they actually have very discounted valuations. So what I mean is that the NAV to the price is at huge discounts. And the interesting thing is that also that a lot of these companies are also looking at accelerating growth. So there are cheaper valuations with higher growth rates. So therefore, we believe that this portfolio would actually provide the clients with attractive risk-adjusted returns in the longer term, as well as all the targets that we mentioned just now. So higher degree of inflation sensitivity.
Okay, I think I can take the question on inflation by Rebecca. Inflation is going down already. Is it still a good time to go into real assets? Very good question. So I think first and foremost, we want to understand that recent economic data shows the economy still remains strong and inflation is not completely beaten. And that is also the reason why there's a lot of uncertainty in the expected interest rates going forward. Now, if you recall earlier on in my segment of the webinar, we talk about real assets as a hedge, not just against rising inflation, but also unexpected inflation. And that is why it is good to have this portfolio as a part of your entire, portfolio allocation. But not advocating for it to be a large part. I think it does have its value to complement your core portfolio as a satellite strategy. Yeah. Unexpected inflation is something that nobody can expect. It comes suddenly, right? And it can be both a supply-led inflation as well as a demand-led inflation. And supply shock inflation are usually a lot more unexpected.
Okay, and I can answer this question on why are we removing the Asian real estate funds. That's a very good question. I think we mentioned previously that firstly, it's geographically specific, so it's very focused on Asia. So when you look at the allocation breakdown, you will actually see roughly around 40% into Japan, 30% into Australia, and the rest split up within Hong Kong and Singapore. So the thing is that what we're trying to advocate is to have a diversification across geographies. So that's the first point. And secondly, the thing is that it has been a very tough time for Asian real estate, and we're actually seeing that the AUM, which is the assets within each fund, has actually dropped quite significantly. So on a strategy level, we are actually seeing that the two funds on our platform have roughly less than 30 million in assets, which is slightly concerning for us. So that's the two reasons why we're actually removing Asian real estate. Okay. So does the portfolio invest directly into assets, e.g., invest directly into buildings or bridges? The answer to this is actually no. So the thing is that the portfolio will invest into companies that invest into these assets. So for example, when you buy a REITs company, you are actually buying the company that actually holds the rights to the REITs. Or for example, if you buy an infrastructure company, they would actually own the underlying assets. So you wouldn't be directly owning each building or bridge per se, but you'll be owning the company that owns the rights to it.
Cool. Maybe we can have two last questions. Okay. Okay. Maybe I can address the one by on the portfolio becoming SRS ready. Thank you for your enthusiasm in investing to this portfolio. And indeed, I think it's very appropriate to be invested with SRS monies because it's for the longer term. But unfortunately, we do not have visibility to when it will be ready. There are so many factors affecting it. As much as we would like for it to be available, by the end of 2024, but it's out of our hand now. So we will, but don't worry, it will not be a stealth launch. Once it becomes available on SRS, we will definitely make an announcement and make sure all our clients get the message.
Okay, and I can answer this question, this last question perhaps. So how do these infrastructure funds invest differently from sovereign wealth funds? Are they limited to only publicly listed infrastructure companies? So the thing is that sovereign wealth funds invest in both the private as well as the public side. So on the private side, on the public side, as mentioned previously, they will invest in companies that owns the underlying assets. But then if you invest in a private fund, typically you could invest directly into the asset. So the thing is that they are actually not only limited to the publicly listed infrastructure companies, but also the privately owned companies. So that could be a difference in that sense.
Okay. Sorry, I know that I mentioned two questions ago, but there's a very good question posted by Stephen. I think it's applicable for everyone. So how liquid is this portfolio supposed to be, given that this is real estate that Endowus consider adding an allocation to semi-liquid funds such as Blackstone? So this portfolio, sorry, it is available to retail clients, and it is daily liquid. If you are looking at semi-liquid funds, these are what we call alternatives. We do have alternative funds that are invested into private real estate and so on and so forth. That is for accredited investors only. Do reach out to your client advisors for a discussion. We have a lot of these options available, but it will not be publicly shared with the retail investors. Thank you. We have some really good interactions and very good questions as well. Unfortunately, we're not able to answer everything in the interest of time, but please do reach out to either support@endowus.com or your assigned client advisor with your questions. We are very happy to assist with that. And please look forward to our email on this RPC that's coming up. Thank you, everyone.
Thank you.
Have a good lunch.